Today chapter is macroeconomics, and we will study a few important things like expenditure approach, GDP, income, business cycle, aggregate demand, inflation, unemployment, demand management through fiscal policy, and creation of money and monetary policy. Previously we discussed economics as a microeconomics. Micro means small, so when we study demand, supply patterns, these are microeconomics. But today we'll see the economy as large, so that is a macroeconomics. Starting for GDP. GDP is gross domestic product, the number and goods and services produced in a country in 1 year. Okay, first I will explain the concept of GDP. GDP stands for gross domestic products, number of goods and services produced in a country in 1 year. Now, as many production you will have means you have more growth, you have more employment, you have more salaries giving to the people, they are spending, so the demand and supply pattern is going very fine. So GDP of China, GDP of some other countries, they are very big because they are producing a lot of things. So then it creates more employment, more opportunity. So every government tries to improve and increase their gross domestic products. So this is what he says, and there is a cycle, you can say GDP cycle, that you have domestic firms, you have international firms, they are providing goods and services, they comprise over a total market value within boundaries of US, and that will generate your annual GDP. But the definition is very clear that number of goods and services produced in one country in 1 year is called GDP. As higher the GDP is, as strong your economy is going. Now, how to calculate the GDP? There are three approaches. One is expenditure, one is income, and one is production. Economics assume that whatever we earn, we spend, which may not be a case in actual, but still, like if I take my income, your income of all people in the city and all the cities, then it will become a national income, right? Otherwise, if I take expenses of mine, yours, everyone's, then and I total them, so it will be national expenditure. So either I take GDP through income method, either I calculate GDP from expenditure method. And the third is production. If I take the total goods and services produced in a country as a production, then also it will be, the answer will be the same as GDP. So these are three important methods that we have. Now one by one we will see more in detail. He says expenditure method says that there is C plus I plus G plus NX. C is consumption, so everyone is, consumer is spending, we are consumers, we are spending, right? Then we save money, we invest, right? So our government is investing, so consumer spending, investment spending in business, they create jobs and other stuff. G is government spendings, and NX is import minus exports. So if you take your consumption, you take your investments, you take your government spendings, and you take your net exports, then you will calculate your gross domestic product. This is another method. So what government spendings? Government in America is collecting taxes. So from these taxes they spend on public. Means every president will make a policy this 4 years what they will do. Some will spend on school, health, infrastructure, airports, technology, and some will do the other way around, right? So we have to see that what is their plan, but this is how government spend on people. Yeah. Yeah, so if you see that sometimes these factors can affect if your consumer spending is increasing, decreasing, investment is increasing, government spending is increasing, decreasing, or export is improving or decreasing, then it will affect the market equilibrium. So every country want to enhance the exports, so they get more money in return, and they want to reduce the imports because import will take out your money out of your country. So this is already I told you GDP by income means you take salaries, rent income, interest income, if you have a business income, or if you have a company which has a corporate profits, all if we will add, this will give you gross domestic product. That is another way to calculate GDP. We do have some other terms that GDP minus depreciation is giving you NOP, net domestic product, measure income generated in US regardless the ownership of productive resources. We can have two type of incomes, indirect business tax, and we have net foreign factor income, that is an excess of income generated in US from foreign owned resources, or income generated in other countries from US resources. So of course, suppose you are out of your countries, you are making money, but you transfer money in your country, so you are actually contributing to your country as well. So there are sometimes as a business, you are a US company, but you are working in, for example, UAE, so you are making money in UAE and transferring back to them, right? So this scenario, your branch in UAE is generating a GDP for UAE, not for US, because you are actually number of goods and services produced in one country. So GDP is contributing to UAE, not to US. But national transfer money that is going back, that is contributing to the national income. This is how it goes. Yeah, in formula type, he showed you salaries, rent, interest, this national income, indirect business expenses, net domestic consumption, and this is your GDP. So in terms of formula, it's very simple. There are two terms that we should familiar. One in personal income is all income received. Disposable income is after tax income which is left to dispose. So your disposable income should be higher, otherwise you will be in trouble. Maybe your salary is big, but when it applied tax, you don't have nothing left with any kind of disposal. So this is also very important. Flow of national income, how national income grows. This is a continuous cycle between consumption and production. We assume that we are consuming and there is a company who is producing. Whatever we are saving, we are investing, these investment going to the companies, and the cycle is going on. So this is what he says. Production, consumer, there is a financial structure, there are multinational companies, there are import exports, and in the center we have government who is putting taxes on sale and purchase. So this flow, if keep going, the economy will be very good. If any flow, like there is an imbalance between production and consumption, then the flow will affect. Means if we have too much production, we have very less demand, so it will have negative effect. But if we have too much normal production but too much demand, so it will generate to another effect. This is how national income flows. Yeah, we have another term called price level accounting, which is nominal and real. Nominal is a gross. Real, any word you say real GDP, real employment, means in that thing adjusted with inflation. What is inflation? Inflation is generalized and persistence increase in the price level. This is how it goes. So he says that how to measure that things are getting expensive. We use real GDP, we take nominal GDP, and we divide with price index. What is price index? Price index will be in this way. There will be a base year and there will be a current year. Like, sometime I say things getting expensive. So